This video covers corporate earnings and distributions. Last chapter you learned that the capital of a corporation is called stockholders' equity. It's divided into paid-in capital, which is the amount paid in by stockholders for ownership in the corporation, and retained earnings. Retained earnings is the amount that has been earned through operations by the corporation. We're going to be focusing on the retained earnings portion of stockholders' equity. Keep in mind that this is a capital account, so its normal balance is a credit. The only way to increase retained earnings is through the corporation's earnings or net income. Notice that net income is the only credit to retained earnings. Retained earnings is decreased with a debit by net losses, dividends, and appropriation, which we'll look more closely at a little bit later. Let's take a look at dividends. Dividends are similar to the drawing account in a sole proprietorship. Both accounts have normal debit balances and indicate payments to owners from the business. In order for a corporation to issue a cash dividend, the corporation must have enough unrestricted retained earnings. It also must have enough cash to cover the dividend, and there has to have been a declaration for the dividend by the board of directors. When issuing a dividend, there are three key dates: the date of declaration, the date of record, and the date of payment. Here's how dividends work. Here's an example. On February 1st, the Board of Directors declares a dividend of $2 per share on 10,000 shares of common stock. The dividend is payable on February 20th to stockholders of record on February 10th. The first thing we need to do is figure out the total dividend that's going to be paid out to shareholders on February 20th. We have 10,000 shares, and each share is to receive $2 per share. So 10,000 shares at $2 will give us a total dividend of $20,000. So on February 1st, the date of declaration, we have to put a liability on the books for the dividends. So we debit cash dividends for the $20,000, and then we credit common dividends payable for $20,000. Now on the date of record, which is February 10th, there is no journal entry. The date of record simply establishes who is entitled to the dividend. So whoever owns the stock on February 10th will be receiving the dividend on February 20th. Now February 20th is the date of payment, so the dividend will be paid on this date with a credit to cash for $20,000 and a debit to common dividends payable. The next dividends we will look at are on cumulative preferred stock. Remember, preferred stock is a special class of stock with special rights and privileges. Preferred stock has a stated dividend rate, and these dividends must be paid before anything can be paid to the common stockholders. With cumulative preferred stock, the dividends accumulate from year to year. So let's take a look at our example. Lancer Corporation has 1,000 shares of 8% $120 par cumulative preferred stock and 5,000 shares of common stock. On June 1st, the Board of Directors declares a $35,000 dividend. The date of payment is June 20th. No dividends are in arrears. It is very important that we know that no dividends are in arrears. That means that we do not owe the preferred shareholders any money for dividends from the previous years. They're paid in full up to this year. So now let's calculate the amount of the preferred dividend. are 1,000 preferred shares at $120 par at 8%. So we will multiply all those figures together to get our dividend. 1,000 shares at $120 at 8% will give us $9,600 as our preferred dividend. Now the dividend was declared for $35,000, so we can figure the amount that the common shareholders will get if we take the $35,000 and deduct out the $9,600, because once preferred is paid, then the common shareholders are entitled to the remainder of the dividend. So we debit cash dividends preferred, $9,600, cash dividends common, $25,400, and then we credit dividends payable for $35,000. Then on the date of payment, which is June 20th, we actually pay the dividends. So we're going to credit cash for $35,000 and debit the liability dividends payable for $35,000. Next, we'll look at cumulative preferred stock with dividends in arrears. We've got the same situation with Lancer, with 1,000 shares of preferred and 5,000 shares of common. They declared a $35,000 dividend, but this time preferred dividends are 2 years in arrears. So that means that before the common shareholders can receive any dividends, the preferred stock has to get the current year dividend plus the dividends for the previous 2 years. So first, let's calculate how much that is. We calculate the dividend the same way we did in the previous slide, so $9,600 per year for the preferred stock dividend, and then we owe preferred stock shareholders 3 years worth of dividends, the current year plus the 2 prior years, because dividends are 2 years in arrears. So that's 3 years worth of dividends we owe to preferred. So that totals out to be $28,800. So the remaining dividend, there's $35,000. If we back out what's owed to preferred, then the common shareholders will get the remainder, which is $6,200. So very similar journal entry. We debit cash dividends preferred for $28,800, cash dividends common for $6,200, and then dividends payable for $35,000. That's our credit. And then of course the entry is the same for the date of payment. Now let's move on to stock dividends. Sometimes if a company is short on cash, or maybe for other reasons, they'll choose to issue a stock dividend instead of a cash dividend. Stock dividends are typically issued as a percentage of the total dividends outstanding. Stock dividends can be classified as either small stock dividends or large stock dividends. Small stock dividends are usually stock dividends that distribute less than 25% of the number of shares outstanding. Large stock dividends typically distribute more than 25% of the number of shares outstanding. So let's look at some examples and see how each of these is handled. Here we have Dividend Corp., who has 4,000 shares of $5 par common stock outstanding. Dividend declares a 10% stock dividend on March 5th, payable on March 27th to stockholders of record on March 14th. The market value of Dividend's common stock on the date of declaration is $12. So the first thing we want to figure is the number of shares that are going to be issued with this stock dividend. Remember, it is stock, so it's issued in shares. So we've got 4,000 shares before the 10% stock dividend. So to get the number of shares issued, you take 4,000 times the 10%. So we are going to issue 400 shares. Now the question is, how much do we record those 400 shares at? Since this is a small stock dividend, which is less than 25%, we are going to record these 400 shares at their $12 market value. So 400 at $12 is $4,800. Then we're going to credit stock dividends distributable. Notice that we distribute stock dividends and we pay cash dividends. So stock dividends distributable is going to hold this credit here until we're ready to issue the stock. So stock dividends distributable is credited for the par value, just like we would credit the stock if we were issuing it. And then the difference, just like when we're issuing stock in the previous chapter, paid in capital in excess of par is the difference between the market value and the par value. Now when it's time to actually distribute the stock, what we simply do is remove the stock dividends distributable with a debit, so we're taking that off the books, and then we're replacing it with the actual common stock that we've issued, and notice that they are both at par value. Next we'll look at an example of a large stock dividend. We still have Dividend Corp with 4,000 shares of $5 par common stock, but this time they're declaring a dividend of 28%. So first thing that we need to do is figure out how many shares we're going to be issuing to our shareholders. So we take the number of shares outstanding, 4,000, and multiply that times 28%, and we come up with 1,120 shares. So now we need to know what value do we apply to these shares. Well, since it's a large stock dividend, we forget about the market value and only record our stock at the par value. So 1,120 shares times $5 par gives us stock dividends debited for 5,600. And then stock dividends distributable are credited for 5,600. So then on the date of distribution, we simply debit stock dividends distributable for 5,600 to remove the distributable from our books, and then we credit common stock to place the stock that we've issued on the books at its par value. Next, let's look at stock splits. Corporations sometimes call in their stock and issue 2, 3, or even more shares in place of each of the shares they had previously issued. This process is called a stock split. Stock splits are usually declared to help reduce the market price per share, and that way other investors can more easily afford the stock because it brings the price down. So let's look at an example of a stock split. Splice has 10,000 shares of $10 par common stock outstanding. Splice declares a 2-for-1 stock split. This means that Splice is taking back the 10,000 shares it has outstanding and is going to issue 20,000 shares in its place. So every shareholder who has 1 share of Splice will have now 2 shares of Splice. The 10,000 shares had $10 par common stock. The new 20,000 shares will have $5 par common stock. And notice that the total amount of stockholders' equity will not change. 10,000 shares at $10 par equals 100,000. 20,000 shares at $5 par also equals 100,000. So there's actually no change in the value of stockholders' equity. So for this reason, we're not going to enter a journal entry. Instead, in the general journal, we're going to enter a memorandum entry that just describes the stock split. So we declared a 2-for-1 stock split, resulting in 20,000 shares of $5 par common stock. So no journal entry is needed with a stock split. So let's move on to appropriations. We learned that a corporation must have enough retained earnings before a dividend can be declared. Sometimes the board of directors may decide to restrict a certain portion of retained earnings to reserve it for a special project. In this case, retained earnings are appropriated or set aside. So appropriations are just restrictions on a portion of the retained earnings account. They're used primarily to limit the availability of retained earnings for paying dividends. It does not affect the total retained earnings. An appropriation just separates the retained earnings into two accounts, appropriated and unappropriated. And it does not affect cash or any other asset. So let's look at our example here. We've got ChemCorp, who's decided to build a new waste treatment plant. It has a retained earnings balance of $900,000. To finance a portion of the plant, the board of directors decides to appropriate $600,000 of retained earnings over a 3-year period. So for the next 3 years, they will be making this journal entry. They're going to debit retained earnings. Remember, it has a normal credit, so to appropriate $200,000 or set it aside, we're going to debit retained earnings for $200,000 and move that balance into retained earnings appropriated for treatment plant. So they were going to appropriate a total of $600,000 over 3 years, so that would be $200,000 per year. After the treatment plant is completed, the appropriation is no longer needed and it's just simply returned to its original state. So we remove the $600,000 from retained earnings appropriated with the debit of $600,000, and then we move the $600,000 with the credit back into the regular unappropriated retained earnings account. Next, we'll examine the retained earnings statement. The retained earnings statement is very similar to a sole proprietorship statement of owner's equity. The retained earnings statement shows the change in retained earnings accounts over the year. In this example, you'll see that we start out with the beginning balances for January 1st for both the unappropriated and appropriated retained earnings accounts. Then the net income, just like on a statement of owner's equity, is added to the unappropriated retained earnings account. This is the regular retained earnings account. Next, we'll see that there were some appropriations made. So it shows where the appropriation was removed from regular retained earnings and placed in the retained earnings appropriated account. So after that move, we've rebalanced to get a new balance in the unappropriated account and the appropriated account. Last, we're going to deduct the dividends that were declared. Remember, dividends reduce the amount of retained earnings. There is only one thing that increases retained earnings, and that is net income, and then appropriations and dividends reduce retained earnings. So we're going to subtract the cash dividends and the stock dividends that were declared for Chem Corporation. So that will bring our total retained earnings at the end of the year for the unappropriated account to $730,000 and in the appropriated account $400,000. The last thing we need to look at are income taxes. One of the disadvantages of being a corporation is that a corporation has to pay its own income taxes, whereas sole proprietorships and partnerships do not. their income is passed on to the owners. But a corporation is a separate entity from its owners, so it has to pay its own income taxes. So a corporation has to estimate its annual income, figure out what its income tax is probably going to be, and then make estimated quarterly payments. Then at the end of the accounting period, when the actual amount of income tax is determined, the corporation has to make an adjusting entry to correct its income tax expense account. So here's an example. We have a corporation that estimates it will owe income taxes of $160,000 for the year. Quarterly payments will be made on April 15th, June 15th, September 15th, and December 15th. So to get our quarterly payment, we take the $160,000 estimate, divide it by the 4 payments, and we come up with $40,000. So the first payment would be on April 15th. The corporation would debit income tax expense for $40,000 and credit cash for $40,000. This very same entry would be made again on June 15th, September 15th, and December 15th. Then at the end of the year, the actual income taxes were calculated to be $163,000. This is $3,000 more than they had estimated previously, so they're going to have to make an adjusting entry for their year-end financial statements. They have got to increase their income tax expense by $3,000 and then put a liability on the books to show the income tax payable for $3,000.